All right. Well, good afternoon. Happy Wednesday to everyone. What I thought I would do is make a quick little video here at the beginning of today's lecture just to do a little bit of explanation. I've gotten a couple questions about Mundell-Fleming, the Mundell-Fleming model in particular, and how we illustrate that model graphically. In particular, this is a very common question. So as you know, the way that I lectured on the Mundell-Fleming was, and I'm going to show you that presentation here to the right, was with a vertical LM curve and then a kind of normal downward sloping IS curve. And then important thing here is exchange rate is on the vertical axis. Now, normally in ISLM, that's the real interest rate. Now, in this particular version of the Mundell-Fleming, what is essentially going on here is that we are fixing the LM curve at a particular interest rate. In a way that sort of simplifies the interaction between policy and exchange rates. So in particular, let's say the federal government decides to run a fiscal expansion. Okay, so all else equal, we know that's going to cause an IS curve shift to the right. And the ultimate result of this is that the exchange rate increases from E0 to E1. And then from that, we can think about what this means in terms of net exports. And so really simply because the exchange rate has increased, this means the quantity of net exports is going to decline, right? So the sort of idea here would be is that if the government attempted to run a fiscal expansion, it's going to put upward pressure on exchange rates, and this is going to reduce net export. Now, the interesting thing, of course, here is that from this perspective, we can see that the net result of this is no change in output, but we put upward pressure on exchange rates, right? That's sort of the story here. Now, another way to illustrate the Mundell-Fleming, and if you just sort of Googled Mundell-Fleming, which I would imagine a lot of you probably did that smartly, you will see a different representation, the one that we have here to the left, and I'll also draw that over here to the right as well. So this maintains the basic structure of ISLM. In other words, we have real interest rates on the vertical axis. And then so we have normal upward sloping LM curve, normal downward sloping IS curve. Now, the addition to this perspective is the so-called balance of payment line. And we're going to just sort of start from the assumption that the balance of payments line is currently is currently at equilibrium here. So let's just do, I don't know why I can't draw a straight line here. Okay, so balance, usually just do BP, balance of payments. And then what we'll do is we'll start from the perspective that the domestic interest rate, domestic real interest rate R is equal to the international, the foreign real interest rate. Typically in the Mundell-Fleming model, you have these two kind of key assumptions, right? The perfect capital mobility, and then the sort of domestic interest rate does not influence the foreign interest rate. That perfect capital mobility is where we get the sort of current situation that R is equal to R star here. That is like the beginning sort of, we have perfect capital mobility. Now, policy is going to change that. So let's sort of think about what this balance of payment line represents. So the way you could think about it is basically that like we can think above and below the balance of payment line. And so what you should notice is that above this balance of payment line, it is the case, if we were up there, then we would have that R was then greater than R star, right? And if it was below, we would have it that R is less than R star. Now, from the perspective of the sort of Mundell-Fleming model, we know that when the domestic interest rate is greater than the foreign interest rate, that this means we're going to have capital inflows, right? So capital inflows meaning that net exports are going to decline. And so the idea here is that when we're above the balance of payment line, so when the ISLM equilibrium puts us above the balance of payment line, then this means net exports are declining. Of course, that should make sense because we also know that if interest rates, the domestic interest rate is going up, then this is going to cause the exchange rate to also go up as well. And so the net result of that of higher domestic interest rates is capital inflows, that is imports coming in and exports being reduced. And so we have kind of that sort of situation. And then, of course, if R is less than R star, then we have the exact opposite. Net exports are going up. And again, domestic interest rate triggering a reduction in the exchange rate. And so ultimately, if we, again, consider the government running a fiscal expansion here, we can see that fiscal expansion, as it did before, is ultimately going to trigger a capital inflow. So net exports are going to decline. Now, let's think about this in the context of what we saw previously, right? Which was that ultimately the fiscal stimulus put upward pressure on IS curve, but that ultimately that resulted in no change in output and just a higher exchange rate. So let's go through this and let's sort of explain why that ultimately occurs in this particular idea of the model. So here in this particular model, we have not necessarily factored price into this. In fact, in the sort of maybe we'll call this simple Mundell-Fleming model with balance of payments, the price is also fixed in that particular model. So price doesn't even move necessarily. That becomes a little bit problematic because, of course, if you have shifts in the IS curve, we know that ultimately that's going to translate into shifts in the aggregate demand curve, right? And similarly, if we have shifts in the LM curve, we know that is supposed to be translated into shifts in aggregate demand. And so in that kind of more basic Mundell-Fleming with the horizontal LM curve and exchange rates, you can't really get to what is ultimately a more dynamical change going on. You just sort of shortcut your way to this idea that output is not going to go anywhere, and we're just going to get upward pressure on exchange rates. But in this balance of payment, we can sort of see, why that is and sort of what ultimately causes that sort of idea. So in this world, again, we're going to shift the IS curve as we would with any sort of fiscal expansion. Now, what's going to go on, of course, is that. So let me get rid of this stuff. This doesn't change, of course, but I just want to kind of add some stuff here. So we know that the IS curve going up is going to lead to an aggregate demand shift up, right? And let me this just a little bit. There we go. And so we know that IS curve is going to cause aggregate demand to go up. Now, of course, the conception of aggregate supply is going to matter here as to what is going on with prices. But from my perspective, what I always did is anytime you had any sort of expansion of aggregate demand, I thought about that in terms of inflationary pressure. So I just sort of, kind of jumped to that conclusion. Now, if the setup is that the economy is currently in dysfunction below potential output, then we may very well be in a flat portion of the aggregate supply curve, in which case boosting aggregate demand does not cause inflationary pressure. But we haven't sort of set that idea up here at all, right? So we can sort of, implicitly assume that we're at potential output already. And so this fiscal stimulus is going to put upward pressure on prices, kind of the classic inflationary cost of fiscal expansion. And so what that's going to do is because price goes up, then of course this is going to cause the LM curve to shift back, and that's because we're getting the change in the money supply, real money balances really is going down, right? And so that's going to cause this shift of the LM curve in this particular direction here. Okay. And so now the idea is that where we sort of initially were getting this little bit of boost to output, right? So this is initial, we'll say that's just full deployment, 0 and 1. We sort of initially got this boost in output here because of the fiscal stimulus pushing the IS curve upwards. But basically, as soon as we sort of get here, the inflationary pressure then sort of does that kind of classic crowd out. It pushes out any of that positive economic growth to the extent that we get that direction. But of course, you'll notice that we also get a much higher domestic interest rate. And again, make this a little bit smaller here, putting this sort of all together, right? And so if the domestic interest rate is rising, we know that the exchange rate must also be rising. So we get that result as we saw before. And then again, what ends up happening is that the sort of fiscal expansion gets completely eaten up by inflation in terms of output. And so all we've done with the fiscal expansion kind of in the sort of the first order and then the second order effects is we put upward pressure on interest rates, upward pressure on exchange rates, and then ultimately no impact on output. And so the idea here is that we can think in this sort of a little bit more complicated way with the balance of payments line. And this allows us to kind of get at some of those sort of pricing dynamics. And then again, this corroborates that simple vertical LM Mundell-Fleming model. And you can see this, in terms of both monetary and fiscal expansion, right? So let's just work real quick through a monetary expansion in that particular model. So again, output, real interest rate, LM curve, IS, and then balance of payments. R equals R star. Okay, so let's say the central bank decides they want to run expansionary monetary policy. We'll assume everything is at sort of potential levels. So the economy is currently at potential output. Again, the truth is that obviously, depending upon where the economy is, that's going to change a little bit about, whether we do or do not want to run a particular policy. And to some extent, it certainly changes like the sort of how we think about, for example, inflation, right? So if you go back to, the idea of thinking about sort of the short run and then the transition into the long run and kind of how we think about that particular dynamic, we're doing a little bit of a shortcut there ultimately, and we're saying that, okay, any sort of subsequent aggregate demand increase over the long run, all else equal, is going to end up in terms of output getting eaten up sort of completely with inflation. And it, the big thing with Mundell-Fleming was that you could show that in a world where the economy was open, right? That was the big sort of thing about Mundell-Fleming, because all this stuff worked, ISLM, equilibrium, and all this stuff, it worked in a closed economy world. And so one of the sort of criticisms of Keynes was really that he didn't think much in terms of open economy. Mundell-Fleming showed that really it doesn't change the story very much as to the effects of policy on output, inflation, interest rates. Because the nature of the global economy is that because it has this sort of fluidity in terms of imports and exports, and especially in a world of financial capital, right? When we talk about capital inflows versus capital outflows, remember, we're talking about financial capital, right? There is capital inflows occurring because there is a creation of demand for currencies so that goods can be purchased from other countries and then imported into the U.S., right? And the same thing, of course, when the opposite is true. So it's important to kind of keep in mind that we at times sort of take shortcuts with some of the more simple models, but typically it's useful to kind of also know the sort of more complicated kind of step by step. And so that's what the sort of more complicated version of Mundell-Fleming ultimately allows us to do. Now, let's go into a monetary expansion as promised. So LM curve is going to shift out in that direction. Now, we can see that when the LM curve shifts out in that direction, we have a situation where now the domestic interest rate has declined. And we can see that in the context here, again, we get at least some pressure on the economy to have higher output. Now, let's go back to thinking about this in the context of aggregate demand. So if we have a monetary expansion, that's going to put upward pressure on aggregate demand. Aggregate demand is going to end up putting upward pressure on prices. And so the sort of second step here is that really the LM curve ends up just sort of getting shifted back on its own. So basically, the monetary policy creates the inflationary pressure that essentially erases, its effect. And so we get this sort of interesting outcome where output comes back to where it was before. Interest rates come back to where they were before, right? And so ultimately exchange rates, right? So initially there's going to be downward pressure on exchange rates because domestic interest rates are now lower, but then that's going to come back around and eventually exchange rates are going to rise back to where they were before. Let's go back to the more basic Mundell-Fleming model that we were talking about before. Y exchange rate, vertical LM IS, equilibrium exchange rate. All right, monetary expansion, boom. Right, we see we get that upward pressure on output as before. We'll call that full, right? So now what happens? Downward pressure on exchange rates, right? Initially. Oops. Right. So the ultimate idea here, of course, is that, again, this LM shift here, right, is going to put upward pressure on aggregate demand. Aggregate demand is going to put upward pressure on prices. And so we get this movement back. We get this movement back of exchange rates, and we get this movement back of output. So, the idea here is that it's a little bit tricky with Mundell-Fleming and prices. The sort of really basic Mundell-Fleming model, sort of makes its assumption about fixed prices. And so we may not necessarily kind of initially think in terms of aggregate demand shifts because we're fixing everything at a particular level of aggregate demand. But then when you start, moving things around more dynamically, as we've been trained at this particular point to do, then you can see sort of how the dynamics end up sort of really just shifting things around. And, this is ultimately one of those sort of ideas that I think pushes the sort of Keynesian perspective a little bit back towards classical. And I think even Keynesians would sort of agree on this. I think that the sense that Keynesians have with respect to trade flows is that we sort of want to let them go. We want to sort of allow comparative advantages to generate all these efficiencies through trade flows. And then we sort of want policymakers to facilitate that trade. That's sort of the idea that mainstream economics feels very strongly about, is that really what government should be doing is facilitating trade. Governments shouldn't see themselves as competing with other governments, but instead we should see that businesses are actually the ones competing with each other, and countries should just be facilitating that particular competition. And so ultimately, when you get this sort of Mundell-Fleming thing where in a floating exchange rate sort of regime, policy ends up not doing a whole lot in the context of net exports, because it really just moves things around. It's capitalist in America making money on domestic products, or capitalist in America making money on foreign production. For them, it's just they're making gains, and what that ends up creating is this sort of exchange rate situation, because you have currencies going back and forth, And then kind of the net result of this ends up being not really a whole lot beyond the fact that we believe very strongly that you get higher output with trade than you would otherwise. And so the sort of kind of net example, or sort of net idea of trade to a mainstream economist who's influenced by both Keynesian ideas and also sort of monetarist concerns over inflation, is that trade really doesn't seem to cause any particular issue. It doesn't seem to be inflationary. In fact, if anything, it seems to be puts downward pressure on prices, especially in the context of specialization driving competition, which naturally we expect to drive down particular prices. Now, that is a world of sort of flexibility. That's a world of market clearing. There is, of course, questions in the context of, for example, perfect capital mobility. Do we actually have perfect capital mobility? And the sort of question there ends up being a lot about, well, okay, then what's the behavior of the U.S. interest rate relative to the general the general foreign interest rate, right? So historically speaking, and I would say, when I say historically, I mean recent history. So in the last 30, 40 years, what we've seen in the U.S. is that the U.S. Has a generally higher interest rate than the rest of the world. And this is for a number of reasons, but in particular, it's because the U.S. has a very low personal savings rate, right? So if we think about this in the context of just the classic money market, we have real money balances, we have money demand, and then we have interest rates. And so in the US, what's happened over time is that because we save less, then the money supply, and sort of in terms of real money balances, is sort of getting pushed downward, in the sense that banks are perhaps having a hard time, sort of doing the classic deposit and then turning those into loans. And so you get this sort of interesting phenomena where, ultimately, if we look at this in the context of, say, the loanable funds framework, which I think makes a little bit more sense here, right? So loanable funds framework is we have this supply of loans, and then we have this demand for loans with a particular interest rate. And so when the savings rate declines, we get higher interest rates. And then, of course, in the context of investment, we get less investment. So this is where we get the less savings is less investment. Well, in a global world, what you get is you get less domestic investment, right? But you don't sort of end up getting less investment overall, because what's going to happen is that this reduction in domestic investment is going to be made up for with investment in foreign capital. So this increase in interest rate domestically simply causes a shifting of investment from the domestic market into the foreign market. And so while you do get this sort of mechanical reduction supposedly in investment, that's only in domestic investment in an open economy world. And so in the US, the sort of argument would be that we have very little savings overall, kind of personal savings is very low, right? This is putting downward pressure on domestic investment because of higher interest rates. And then is that corroborated in the actual data? And it says yes. So if you look at the data, you actually will find that the U.S. interest rate is slightly higher than the rest of the world. That also is true in terms of the U.S. saves comparatively less than the rest of the world. We're very lucky in the U.S. in a sense that we are able to have such access to capital markets in other parts of the world. So again, in a sense, the U.S. gets away with this dynamic because of our access to foreign markets. And so in a world where perhaps our access to foreign markets is being disrupted through, trade protections, tariffs, other barriers to trade, but perhaps our savings doesn't change such that we continue to have upward pressure on domestic interest rates, then what that's going to do is that's going to sort of overall see an actual decrease in investment, because now the ability to invest in other parts of the world is going to be made much more difficult through trade restrictions. And so if the U.S. interest rate stays high because U.S. consumers continue to not save very much, then the trade restrictions combined with the higher interest rates is going to correlate to lower overall investment. We're certainly going to get less foreign investment because through trade restrictions, but then we're also going to get less domestic investment because of higher interest rates. So this is, of course, one of the reasons why Trump is very adamant about his belief that the Federal Reserve should be targeting lower interest rates right now, right? So this is June 4th, 2025. The Federal Reserve is in a very defensive posture, a la inflation right now. So, from their perspective, I think they stand kind of at the ready, if anything, to put upward pressure on prices. I'm sorry, on interest rates, so as to sort of avoid inflation. I think Jerome Powell, the Fed chair, has sort of said in the last few Fed meeting minutes releases that they're very concerned about the inflationary pressure potentially from tariffs, and they're not necessarily in a position to acquiesce to the presidential demands for lower interest rates, given their belief that right now what is more concerning is inflationary pressure versus the unemployment situation. Right, we're currently below 4.5% unemployment. That is historically certainly what we would consider full employment. And so the concern is that we're sort of at the point where employment's already putting sort of inflationary pressure. And so the Fed can, again, right, the Fed's trying to kind of ease some of this inflationary pressure with higher interest rates. Basically, the higher interest rates are about keeping unemployment where it is, not allowing unemployment to fall any further. Now, politically, this is very problematic for the Fed because politicians can say, look, they're keeping us from having jobs. And this is definitely something that both sides of the political aisle in the U.S. do all the time. Both sides of the political aisle basically always want low interest rates, with the exception of, I will sort of commend, there are some inflation hawks on the more conservative side who I think, their adamant continued, yelling about inflation and concerns over loose monetary policy is actually, a good thing, given that, we had very loose monetary policy for a long time. The Powell Federal Reserve, post COVID, I think has done a great job in sort of like acknowledging that inflation is this big issue. But we also have this dual mandate. But what do we think is more important? And for the last couple of years, unemployment's been low enough that I think Powell and the Fed have rightly sort of been concerned about the inflationary pressure. We saw it, by the way, at the beginning of 2025. There was some added inflationary pressure in the economy, and we're going to continue to sort of be somewhat worried about that. The tariffs are a big question mark, because the tariffs themselves are a big question mark. We don't really know exactly what they are sometimes and what that ultimately is going to mean. But there is some concern there that we have kind of an inflationary pressure. And so what it does is it sort of, I think to a lot of economists, that sort of trade side, we sometimes can ignore, because it just sort of represents this net sort of positive. And so ultimately, you can kind of think in terms of the basic ISLM. You don't even have to think in terms of Mundell-Fleming. And then you just know in the back of your head, upward pressure on interest rates is going to put upward pressure on exchange rates. Upward pressure on exchange rates is going to reduce net exports. And you can think about what that would mean for a country like the United States, given sort of how it is that we earn our particular incomes. If we were a small open economy, the loss of net exports would be much more concerning, given that we're a very large open economy, also given the fact that we're the world's reserve currency. Again, the loss of net exports due to capital outflows doesn't seem like anything that economists are really worried about economically. I think, again, it becomes politically important, certainly, and that's not just in the United States. Trade and globalization and its use as a political cudgel occurs all over the place, and I think that's one of the biggest concerns for economists, is that it seems like people are in a sense losing their appetite for trade, despite, for us, we feel like clear evidence that trade is inherently good.